Welcome back, everyone. It's 12:25, Tuesday, February 7th. About to have Powell come on and speak in about 3 minutes. 13 minutes. He's scheduled to speak at 12:40, but we're starting this live session at 12:30 because I wanted to do a little bit of a recap of what the trading has been this morning. So we started to go up at around 11:05. Trying to find any news that would have led to that. U.S. Democrat leader Chuck Schumer says situation with China is tense. Biden administration looking at other actions that could be taken. So, no news that really entered in the markets going up. Probably just technical breakout going above the morning high. And then holding that for a little bit. Ended up pulling back. And now we're kind of almost retesting that at support around 409.50 or so. So, Powell's going to be speaking in 12 minutes now, and we've just been in this range, so this is exactly what I was expecting, either selling off this morning, we already sold off in the pre-market, or trading flat, and we bounced at the 408.50 level. We got rejected at the 410.79 level. So Powell's speech will dictate which way we go next. So get ready. I'll show you all the positions that I've currently got open. 2 bearish positions, 1 bullish position. The SPY call credit spread, assuming that SPY will end the day below 413. I might end up taking profits on this pretty quick in the next 12 minutes before he speaks, because I don't want to be over leveraged one side or another. But I've also got a 407, 406 put debit spread. Currently down $60 on that. And then for my bullish trade, I have a GLD leaps option with a 160 strike price. Whenever the dollar goes down, if he's more dovish than expected, if he's basically saying the same stuff that he did last Wednesday, that's going to send the dollar down. Gold will go up with that. So I'm going to take some quick profits here for the call credit spread. Deleverage myself to the downside. And I've got 4 of these. I'll make like $30 in profit. Not a lot, but it's nice to take profits where you can. I'd rather make money than end up losing it if we are bullish. I open these at 22 cents a piece. I'm going to try to close them at 21. Hopefully we get that order filled. With Robinhood, there's really no knowing. Let me run a poll. Which way will the markets go? No, I'm not bullish. I am tilted more bearish for the short term, but then that gold leaps will buffer any upside if that does happen. All right. Are we bullish or bearish after Powell? Green, red. All right, let me run that poll, see what y'all are feeling. Get rid of my one-on-one coaching message right quickly. And we shall get started in about 10 minutes. And I'll cut myself off once he starts speaking. I won't interrupt what he has to say. What he has to say is a lot more important than anything that I can say. So I will give my comments along the way in the chat, in the live chat. And you'll be able to see what I'm thinking at the moment. Zoom just announced 15% job cuts. Jesus, 15%, that's pretty damn big. I mean, that's very common, I would say, especially in tech right now, just because like these people are, I don't want to say that they're overpaid. Like they have the skill set to where they should be making, 6 figures. Like if you're in STEM, science, technology, mathematics, and I forget what the E is right now. But if you're in STEM, like, you should be getting $100,000 a year. So it makes sense for them to be making that much. But the problem is, since they're making that much more than your average person that's making $50,000 a year, it's a lot harder to afford that for the companies that are paying them that much. Zoom is up 5% after that. Yeah, that's the typical reaction whenever you get a layoff, is skyrocketing. Because people see it as a way of cutting expenses and boosting their earnings per share, which is true. But at the same time, this means that there's a lack of demand going on. All right. Looks like we got this going on. This is interesting music, but okay. I'm feeling it. It's like lo-fi music. I see you, pal. Rocking some jazz. Oh, yeah. True. Forgot about copyright. That would have been dumb. Yeah, so I'll wait till they actually start speaking, that way I don't demonetize this video. Stupid YouTube. Is the music bullish? I mean, it's good vibes. Markets don't care about the music, though. What do I think Powell is bringing to the market? Or do I think that he's bringing the market down today? It's hard to say. Based on his last speech, it makes me tilt a little bit more bullish. Because they're saying that they're data dependent, and I'm curious if he will reiterate that. Because data dependent means that, well, at least last week, before the meeting, it meant that where we might end up cutting rates. But now with the jobs market coming in so hot after the last payrolls, the non-farm payrolls, if this data keeps coming in red hot in the labor market, they have to cool off the labor market. In order to get inflation down, that's a necessary evil for people to get laid off. So there's less money flowing into the economy, and prices will not go up as quickly. But if people can negotiate 4% higher wages each year, and we're not increasing our production, then the price of items is just going to get 4% higher each and every year, unless people start magically saving their money, which is possible, especially with the Fed encouraging savings. I mean, if you're looking at a high-yield savings account right now, you're getting along the lines of like 3.5% to 4%. So that does encourage savings, but at the same time, like, people can't really afford to save money right now because of the high inflation in general. You know, there are special cases of people like myself. I am a very minimal spender, I'd like to say. I only spend maybe $3,000 a month between my wife and I, whereas our income is usually above $6,000 a month. Right now, we're spending a shit ton of money on an app to develop an app, so our savings is starting to kind of, reel back a little bit. But, we're saving half of our income, so we're in a good spot. Whereas a lot of other Americans, I would say, like to overspend. They like to have the newest vehicle. They like to have the best house. Whereas for me, like, I'm only paying $1,100 in rent when I could move to like a $2,000 a month place, have a much nicer setup than what I've got here, and I could be driving a Tesla, whereas in the meantime, I'm driving a Hyundai Sonata from 2017. So I would say save money wherever you can, but that's just not the American way. Americans love to overspend. They love to take out debt, especially. So I would say try to save as much money as you can if you can. try to cut your expenses the best you can. What state do I live in? I live in Pennsylvania. $1,000 a month on food. Jeez. Yeah, I think our grocery bill definitely went up with inflation. It used to be $300 a month. Now I would say we pay $120 once a week. So it's more along the lines of like $500 now. So it used to be $300, now it's like $500 a month for groceries. We are eating a lot healthier, I would say. A lot more fruit in our diet. I have cut out meats for the most part because they are expensive as hell. And I've been trying to do like a more plant-based diet, a lot more fruit, like I said. Tofu is my meat supplement. And, just trying to be more lenient. Like, it's helped me lose like 10 pounds in the meantime. So, it's been nice. But, yeah, my grocery bill's like $500. My rent is $1,100. Our utilities are like, I want to say $200. The car is $300. Gas and insurance would probably run me $150. So I might not even be spending $3. What other expenses can I think of? Food, house, transportation. Those are the main expenses, and then discretionary, especially with the new baby coming. I don't know if we spend $1,000 discretionary. I'm not sure what else I would include, but I'd have to look more into my spending habits. But I'm doubtful that we spend more than like $2,500 or $3,000 a month, where we make, $6,000 a month in income between the two of us. 28 to 30 miles per gallon on a Corvette? Damn. That's pretty good gas mileage for a V8 engine. P-Town, yeah. I'd like to call it Piss Town. I'd hate it where I live, but manual transmission. Ooh, I'd love to drive that. I would love like a nice vehicle, but at the same time, like, I'm not gonna pay nice vehicle prices. Like, I'm not gonna spend. If you want a new Tesla, like, you're spending like $600 to $800 a month, which is like twice what I'm paying now, and I'm like, is it really worth it? Probably not. If the only reason why I would want to buy a Tesla versus, my current car would be the safety aspect of it, with Teslas being the safest cars on the road according to NHTSA. That would be the only reason that I would switch, just for the safety of, my child and my wife. But I'm just not at the point to where I want to be in order to afford that. Like, if I want to buy a Tesla, if I want to move to a nice place, I want to make more than $10,000 a month. Ideally, like $15,000 to $20,000 a month. I want to save as much income as I can, basically. Get a nice cam to capture every moment. Yeah, we've been just capturing it with our phone. It's been, oh man, it's been great since she's been around. We've been taking lots of pictures of her. We had a cute little outfit that we put her in yesterday. All right, Pal should be coming on to speak in about a couple minutes. He should be speaking right now, but yeah, we've been taking lots of pictures of her. I cried whenever she was born. My wife cried whenever she was born. That was a beautiful moment. We got to capture it with the phone's camera. Ooh, I love the BMW M3. I'm not sure if I like the new BMW M3s though. I think the grille, like, I've kind of got used to the grille and starting to like how it looks, but it's definitely a deviation from what they were previously. All right, Pal's about to speak, so I'll shut my mouth.
Attention, please. Can I have your attention? Okay, thank you. So, as I think everybody knows, our special guest is the chairman of the Federal Reserve Board, who has now completed 5 years as chairman as of 2 days ago, your 5th year, and now been on the Fed board for almost 12 years. So, Jay, thank you very much for being here. And why don't we start with an easy question? So, you made a speech last week commenting on the FOMC's decision to raise the Fed discount rate by a small amount, relatively speaking, 25 basis points. Some people would say that was small. But at the time, it wasn't clear that the jobs report would be as strong as it turned out to be subsequently. Had you known that the jobs report was going to be as strong, would you have done 25 basis points or something different?
David, thank you for that question, and thank you, thank you for inviting me here today. It's great to be here. So we don't get to play it that way, unfortunately. We have to, but I'll take it this way. So the message we were sending at the FOMC meeting last Wednesday was really that the disinflationary process, the process of getting inflation down, has begun, and it's begun in the goods sector, which is about a quarter of our economy. But it has a long way to go. These are the very early stages of disinflation. So the services sector, really, except for housing services, pardon me, is not really showing any disinflation yet. So our message really was this process is likely to take quite a bit of time. It's not going to be, we don't think, smooth. It's probably going to be bumpy. And so we think that we're going to need to do further rate increases, as we said, and we think that we'll need to hold policy at a restrictive level for a period of time. Then comes the labor market report for January. And it's very strong. It's certainly stronger than anyone I know expected. And so, but I would say, we didn't expect it to be this strong, but I would say it kind of shows you why we think that this will be a process that takes a significant period of time. The labor market's extraordinarily strong. And by the way, it's good. It's a good thing that inflation has started to come down without it. That has not happened at the cost of a strong labor market. So, and of course, since then, financial conditions have tightened significantly since then.
So let me ask it another way. So, by the way, when the numbers coming out, the jobs numbers, 519,000 jobs, does anybody call you up in the government and give you a little heads up, this is going to happen, or they never do that?
So on some data, sometimes we get data just the night before, and it's only me, and but not on all pieces of data. It's a very small amount of data, and we get it just the night before. For example, if we were going to get a big piece of data in the middle of an FOMC meeting, as often happens on the day of an FOMC meeting, it will help me to know it the night before.
Okay, so the markets, after your speech last week, the markets assumed that, therefore, there would probably be another 25 basis point increase in your next FOMC meeting. Was that a bad assumption by the markets?
So what we said at the meeting was that we believe that we anticipate, is what we said, that ongoing rate increases will be appropriate. And the reason is we're trying to achieve a stance of policy that is sufficiently restrictive to bring inflation down to 2% over time. And we don't think we've achieved that yet. So we said that, and now you see the labor market report, and I think, again, financial conditions are more well aligned with that than they were before.
So the assumption when you made your speech was that probably the Fed might even consider decreasing rates by the end of this year, and the markets no longer assume that. You think the markets are wrong?
Well, so let me say, these are all of these numbers that we're throwing around here are conditional on incoming data and what happens. So we never say this is what we think will happen. We make a tentative forecast and then we let the data come in. For example, if the data were to continue to come in stronger than we expect, and we were to conclude that we needed to raise rates more than is priced into the markets or than we wrote down at our last group of forecasts in December, then we would certainly do that. We would certainly raise rates more.
Okay, so today, for people who aren't familiar with the FOMC, who actually is on the FOMC?
So the U.S. Central Bank consists of a board of governors here in Washington. There are 7 governors. Those governors are nominated by the president and confirmed by the Senate, and we serve terms that are not synced up with the election cycle. So we're independent. There are also 12 reserve banks around the country which have a degree of independence. And so each reserve bank is led by a president who works there full time. All 12 of them sit on the FOMC. So that's 19 people sit on the FOMC. So it's quite a large committee, of which 12 vote in any given year. The reserve bank presidents vote on a rotating basis, except New York, which votes every year.
So when you vote, do you vote at the beginning of an FOMC meeting and then just kind of have discussions afterwards, or do you wait till the very end and then you vote?
No, we vote at the end. I mean, the FOMC meeting process takes, more than a full week. I'm talking to all of the participants, all 18 other ones, and staff has sent around memos, and there's something called the Teal Book, which is the staff's assessment of the, of the economy and international economy and monetary policy and all that. Then we have an extensive discussion on the morning of the first day about the economy. Everybody talks about that. On the second day, we talk about monetary policy, and then we vote on monetary policy at around noon on the second day.
So does the chairman of the Federal Reserve Board speak first and say, here's what I think, or does he wait until the end and say, well, thanks for what you think, but let me tell you what I think? What do you do, first or last?
Different chairs have done it different ways, and so I've tended to do what my immediate predecessor did, I think. Well, this is what I do. I speak last on the sort of the economic go-around. So everyone else talks about what they think about the economy and in their district, for example, if they're a Reserve Bank president. And I listen to all that, and then I give my comments at the end, and I kind of sum up what people have said. And then I speak first on monetary policy.
Okay, so you've said your inflation rate target is 2%. But why 2% and not 3%? 3%, could be tolerable, really. I mean, for most of organized history, 3% is considered okay. Why do you want 2%?
So 2% is the global standard, and that is our objective, 2% as measured by the PCE index. And that's not something we're looking at changing. That isn't going to change.
That's not going to change?
Not going to change, no.
But, okay, so you need to get to 2%, and your goal to get there is by what period of time would you like to get there?
Well, we say that we're using our tools to get there over time. If you look at our forecasts, we expect 2023 to be a year of significant declines in inflation, and it's actually our job to make sure that that's the case. But I would tell you that, with inflation, headline PCE inflation is running about 5%. This is on a 12-month basis. Core is running at 4.4. My guess is it will take certainly into not just this year, but next year to get down close to 2%.
Okay, so 2% is firm. You're not going to get off that.
Yes.
Okay. So the theory of raising interest rates is that it will decrease economic activity and increase unemployment. But you've been increasing interest rates for a while, and unemployment is now at a record low. So what's wrong with the theory? Why is unemployment not going higher?
Well, the labor market is strong because the economy is strong. And as I mentioned, it's a good thing that we've been able to see the beginnings of disinflation without seeing the labor market weaken. It's just that there's a lot of demand for workers. In fact, if you look at the supply of workers versus demand for workers, demand for U.S. workers is now more than 5 million greater than the available supply. And the available supply consists of people who are either working or actively looking for a job. So this was not the case before the pandemic. The pandemic really had left a lasting mark so far on labor supply in the United States. The labor force participation rate came down, and there now is a shortage of workers, and it almost feels more structural than cyclical. So that's a significant issue.
Now, you've resisted, I think, saying what unemployment rate would be acceptable to you, I think. But is there an unemployment rate that you think would moderate inflation such that you would tolerate unemployment at 4%, 5%, 6%?
I guess I think about it this way. We have two goals that Congress has assigned us: maximum employment and price stability. Price stability, as we've agreed, is 2% inflation. Maximum employment means if you want a job, you can get one. So right now, the labor market is at least at maximum employment. Many would say that it is out of balance with more demand than there is supply. So what we're trying to do is get inflation down. We're not targeting a different unemployment rate. We're trying to use our tools to get inflation to come down over time.
In hindsight, would you say that when COVID hit the economy and we injected $5 trillion of fiscal policy into the economy, and the Fed did quantitative easing and other related things, kept interest rates very low. Would you say in hindsight that was a mistake, or was the right policy at the time?
So I think you have to go back to the decisions that were made in real time, and it was something nobody had ever seen. The global economy came to a virtual standstill. People were talking about depression. People were talking, and we didn't think, we had no idea when we would get vaccines that worked. So Congress took very strong measures, and we took very strong measures. And you see where the economy is. You've got a very, very strong labor market, but you have high inflation. As I mentioned, we're at the beginning of getting that down. If you look around the world, though, at other countries, they're also experiencing high inflation, including countries that didn't do as much as we did, either from a fiscal or monetary standpoint. So that tells you, though, that a big part of this inflation is actually related to the pandemic itself, the shutdown and then the reopening. That's a big part of it.
Now, the quantitative easing program has increased the balance sheet, I guess, of the Fed. And what is your balance sheet now?
I think it's $8.4 trillion.
You must sound like you know. Sounds like $8.4 trillion.
That was yesterday's number.
Okay, all right, $8.4 trillion. What would you like it to get down to over the next year or two? Is there some lower number?
So we are in the process of shrinking the balance sheet actively, actually passively, I should say. So what happens is as Treasury securities on our balance sheet mature up to a monthly cap, the balance sheet shrinks in that amount. Same thing with mortgage-backed securities as they are prepaid or so the balance sheet is shrinking. In terms of the target level of it, we haven't put a specific dollar number on it. The idea is we're in a regime of ample reserves. Reserves are basically deposits at the reserve banks. And when we get close to that level where we feel that reserves are ample, kind of where we were before the pandemic, then we'll slow down and we'll sort of test where we are. But it'll be a couple of years, we think, till we get to that level.
The Fed does not sell securities. They waits for them to mature, and then you just cash them in, right? You're not in the market selling securities that are not yet mature. Is that correct?
That is correct. It's also correct, though, that we've said we would consider sales of mortgage-backed securities, but I will tell you that's not something that is on the list of active things being actively considered.
So some people that are worried about the federal debt limit and that we might not be able to extend it on time. We have $31.4 trillion of debt. Are you a little worried about the debt limit not getting extended?
So the debt limit is really something for the fiscal authorities to deal with. The Fed, our only role in this is that we're the fiscal agent of the Treasury Department. We're not a policymaker on that. And I will just say this. This really can only end one way, and that is with Congress raising the debt ceiling in a timely fashion so that the U.S. can pay all of its bills when and as due. That's what has to happen. And if that doesn't happen, no one should think that the Fed has the ability to shield the financial markets or the economy from the consequences of moving too slow.
So you don't have any program in place ready to go if, in fact, the debt limit isn't passed in time?
This is something that Congress has to deal with.
And the so-called trillion-dollar gold coin solution is not one you're in favor of, I guess.
As I said, this ends in only one way,
okay.
And that way is Congress voting to raise the debt ceiling so that the U.S. can pay all of our bills.
Okay. In terms of consultation, do you consult regularly with the Treasury Secretary or the head of the National Economic Council or the President of the United States? How do you kind of relate to the administration?
For a long, long time, 60 or 70 years, I think there's been a weekly breakfast or lunch with the Treasury Secretary and the Fed chair. And that's what I've had with Treasury Secretaries that I've had as Fed chair. I've also had regular, or call it irregular lunches with the head of the NEC. We also have regularly scheduled lunches with the Council of Economic Advisors. And that's really the institutional structure of our contacts with the administration.
So in the way the Fed works today, if you could reconstruct the operations of the Fed, would you change the legislation in any way? Would you think the Fed operates in a way that's as efficient as you can realistically operate?
We're not looking for any changes to the Federal Reserve Act. I mean, I think it does work. The structure that I discussed earlier, where you've got the 12 Reserve Bank presidents coming in, what that assures, really, it institutionalizes diversity of thought. So we get different people coming in who've got different backgrounds, different careers, and they think different ways. And I think that's enormously beneficial to our decision-making process.
So there has been discussion recently about the Fed, some Fed members, Fed board presidents, selling their securities and maybe not doing everything they were supposed to do in terms of disclosing it. What have you done to fix that process?
We put a new system and a new set of rules in place, which I think are best in class for a public institution like the Fed. And the innovations were that if someone wants to sell something that they own or buy something, they have to clear that in advance with staff at the Board of Governors, and then you've got to wait 45 days for that to execute. Also, you can't own individual stocks, and you can only authorize these transactions or execute them during specific times. And we disclose, of course, all of these are disclosed. If your idea is to trade things, buy and sell them because you think this stock is cheap and that kind of thing, that's just not something that will work.
So what is the salary of the chairman of the Federal Reserve Board?
It's around $190,000, I believe.
Okay, so you live on the $190,000. If you need to sell something, what do? You have to clear it for 45 days? Or?
That's right. If we have family expenses that, if we have them, that exceed my salary, then we have to sell an asset.
You think that's a fair salary for the job? Or?
I do, yes.
You do. Okay. So today, how do you coordinate with central banks, let's say in England or Japan or China? Do you have regular conversations with them about what they're doing?
We do, and I meet 6 times a year in Switzerland with the heads of of many central banks, even the small and medium-sized ones in Basel at the Bank for International Settlements. In addition, among the major central banks, I have regular dialogues going with most of them, and so what we're talking though about is really what's happening in the economy and how are you thinking about policy and that kind of thing. It's very important that we keep those discussions going because, particularly in a crisis, you're going to need to know each other, and you're going to be able to trust each other.
And do you think the U.S. economy is pretty much in control of its own inflation rate, or are there events outside the United States like what China is doing or the Ukraine war that are affecting inflation and make you nervous about where inflation might be going?
We have the tools. The Fed has the tools to achieve our 2% goal over time, but inflation in the United States is, of course, very closely related to things that happen here, including the balance between supply and demand. It's also affected by, for example, commodity prices that are really set on the global markets. Oil and many agricultural commodities are priced globally. So there are certainly, it's an integrated global economy and global markets, and we are part of that.
So you get data from all the various government agencies, but do you ever use anecdotal things like you go to the supermarket and you say prices are high and you say this price is high, or do you ever get anecdotal things, or people ever call you up or friends and say, by the way, you should do this or that? Do you ever get that kind of information, or do you only get it from the government reports?
I mostly get data, but I will say I do believe that anecdotal information is very useful, and one of the things the reserve banks are great at is all 12 of them have big operations where they talk to businesses and nonprofits, universities, every sector of the country and the economy, and they bring that back to the FOMC meetings and they talk about what they're seeing. Because often, staring at data is great, but you need to have a story, and I think hearing the stories that people tell, it does help me to sort of assess what's going on out there.
So as the chairman of the Federal Reserve is obviously an important job. How do you reduce the stress level you have? I mean, you can't be watching economic numbers all the time. So what do you do to relieve the stress other than interviews like this?
The usual things. I read pretty light fiction, detective and spy fiction. I exercise as much as I can. As you know, I like to ride my bike. I play the guitar, play music.
Wait a second, is that safe, riding a bike? Dangerous? And
It's safe. It's safe if you stay on the bike. And
okay. You're good at that.
That's what I try to do.
And you still play the guitar, or you're still...
I do, yeah.
Your hair is awfully short for playing the guitar. Don't you need longer hair? Was
Yes.
your hair longer when you were younger?
And grayer. It's too gray, too. So.
Okay. So let me ask you about the issue of what it's like to be chairman of the Fed. You can't go have regular friendship kind of dinners or meetings, can you, with people? People treat you much differently, I assume, than they used to, right? When you go to a restaurant, are people listening to what you're saying or something like that?
I have always thought that my jokes were funny, David. But no, so yes, it's I've never been a public figure before like this, and it's very different. But it's a great honor to serve. But yeah, when you go in public places, you have to be very careful about.
And
what you
does
do.
the President of the United States ever call you with any advice, or you don't realize did President Trump ever call you, or President Biden ever call you, or?
Well, I think it's a matter of public record that President Trump did used to call me from time to time.
Okay. What did he call you?
No, I haven't had that kind of. I haven't gotten any calls from President Biden.
Okay, so the biggest challenge you have now is being able to keep a straight face, not telling people what you're going to do in the future, and look at the data and then come up with the right solution, right? That's mostly it.
I think the biggest challenge we face at the Fed is completing the process of getting inflation down to 2%. And what I want to point out is that we're seeing disinflation in the goods sector. We expect to see it in the housing services sector, and these are the three parts of the core PCE inflation index that we look at. There's 56% of the economy, which is the rest of the services sector. It's the biggest part, obviously. And we're not seeing disinflation there yet. And that's going to take some time. And we need to be patient. And we think we're going to need to keep rates at a restrictive level for a period of time before that comes down.
So when you made your speech the other day, when you talked about the Fed discount rate, you used the word disinflation 11 times. Not that I'm counting, but 11 times. So you were saying that disinflation is beginning to appear. Would you use that word 11 times again today after the jobs report, or you would be less inclined to use that word so much?
I might use I might say I would certainly use the word disinflation, yes, which means declining inflation, and I would call it declining inflation too.
And today, what about the total debt of the United States, which produces some inflation, 31.4, leaving aside the debt limit? Are you worried about the total indebtedness of the United States producing inflation, or you don't think that's a big problem?
Yeah, it's not the level of debt. I would say the thing I'd say about the level of debt is really, it's not. First of all, it's not the Fed's job, but I would say that we're on an unsustainable fiscal path at the federal government level. That has been the case for some time, and it's something we will have to deal with. And it's better to deal with it sooner rather than later.
Now, many of your predecessors were economists. You were trained as a lawyer. They spoke in what I call Fed speak, which is to say incomprehensible kind of economic language, which was done intentionally, I think, sometimes they would say. So you tend to speak in English. Has that been a plus, you'd say, when you're dealing with members of Congress, they can understand what you're saying?
I like to think so. I've made it a real priority to engage a lot with Congress. In our system of government, unlike the parliamentary system, our accountability is to the legislature. It's to Senate and the House, and particularly the two oversight committees, Senate Banking and House Financial Services. And I think it's very important that we respect that and explain what we're doing and listen to their concerns and share with them how we're thinking about things. And I think they appreciate that. But that is, we have this precious independence. We can't be removed from office. We serve these long terms. The other side of that has to be accountability. And the way for us to get accountability is to be as transparent as possible and try to reach, the people of the United States through their elected representatives. So this is a very high priority, and we're going to keep doing it.
So when you testify in front of Congress, how much time does it take to prepare for that? Is that a 1 hour preparation session, or is it a 1 day session, or a 1 week session?
These are supposed to be monetary policy hearings under the Humphrey-Hawkins Act, and they're actually on anything that's any political issue. So it's quite extensive. You have to prepare for everything that the Fed is involved in and many things that the Fed is not involved in. So it's a lot of preparation.
So when you get questions from some members, do you have to bite your tongue and say, why are you asking a question like that, or you never have that problem?
That never happens.
Never happens. Okay. All right, well, good. So today, as you look at the country's economy, what is the biggest worry you have about inflation? Is it just that the fiscal policy is not completely under control? We have exogenous events outside. What is your biggest worry about inflation today?
Well, it's kind of what I was saying earlier, which is we're just at the beginning of this process, right? Goods inflation. So we need that process to continue. The whole thing began, the whole inflation began with people not being able to buy services, instead buying goods, and then global supply chains collapsing. And so you couldn't get goods, and prices of goods went up, and that's where it started. But that is now starting to get better as supply chains are improving and as people are rotating their purchases back to services. You move on, though, we're not seeing it yet in housing services, which is either rent or the ownership, the imputed costs of house ownership. But we expect to see that. So we need that to happen. That's another big part of the economy. It's got to come. It should come in the second half of this year. Then the biggest piece of it, and what I worry about the most, is when are we going to see disinflation or declining inflation in core services ex housing? So that's what I worry about. The last thing I worry about is just another exogenous event. It's a risky world out there, with the war in Ukraine and the reopening of China, and those are things that can affect our economy and the path of inflation.
Right. So the balloon was not your worry, though. You don't care about the balloon.
It's not within our ambit.
Okay. So today, the Federal Reserve gets data from all over the country, and are you convinced that you get the best data, you have the best data collection methods, or do you think it's not as modern as what Wall Street gets?
So most of the data that we get are just the same. We don't collect the data on unemployment or inflation or most things. So most of that's just government data, and a lot of that's, for example, very high quality. The labor market data is very high quality. What we get, which I think is better and different from what everybody else gets, is what I mentioned earlier, and that is the Reserve Banks putting together the beige book, putting together the beige book, and also coming in and sharing the anecdotes and what they're hearing, what's happening with each district is different. You have agricultural districts and energy districts, and so that I think our anecdotal, but also just the haul of information we get through that network is I don't think anybody else has that.
So do you consult regularly with some of your predecessors? I mean, obviously one is Secretary of the Treasury now, but Ben Bernanke, for example, or...
I do. I talk to former Chairman Bernanke. I talk to, Secretary Yellen. I still talk to Alan Greenspan now and again.
And when you're dealing with your colleagues on the Fed board, and you disagree with them, do you say, "Look, I'm the chairman of the Fed. I am the person who has to make the final decision, and this is what we should do," or you don't quite do it that way?
It's a process of reaching agreement, and I hear what people have to say. I tell them what I think, and then I'm the one who has to bring a proposal in front of the full committee, not just the board, but in front of the full committee on monetary policy. And it works. We have to reach an agreement, and we get to a place. I think you can tell today we are blessed with a diversity of perspectives on the FOMC with 19 people. Of course we are. But you have one thing that unites all of us, and that is a very strong commitment to getting inflation down.
So in some parts of Washington, people say, if you give me this, I'll give you that. I'll trade this for that. You never do that at the Fed when you're coming up with a decision. I'll do what you want if you do what I want. That doesn't happen ever?
Not really, no.
Oh,
no.
Okay.
Like you mean a better office or something like that?
Well, just, I'll say what you want me to say if you say what I want you to say or something. That never happens, right?
No, it doesn't happen. I mean...
And when you want to talk to members of the board, of the Federal Reserve Board, do you go to their office or do they come to your office?
I like to do both.
Oh.
I mean, I really don't like to sit in my office all day and have people come to see me. I like to go barge in on people, and I think it's much better to get up and walk around and see people.
But the Fed has been pretty good at avoiding leaks of its decisions. How do you do that? Because most people in Washington are not so good at that. How do you avoid leaks?
We do have, we've got very strict rules around confidentiality, particularly around the written materials that we have. We publish these things internally for the FOMC meeting, the memos and the Teal book and all that. But the other thing to remember, though, is, we're not trying to hide our decisions from the public. We actually, in modern monetary policy, we want the public to understand how we think, how we're thinking, and if markets really understand how you're thinking and a new piece of data comes in, the markets will go, well, they're going to do this, and it sort of happens organically. And that happened all last year. As we were talking about raising rates, the market priced in rate increases long before we actually enacted them. So we want to be transparent. We're not looking to surprise markets with these decisions.
But from the time that you make your decision on the FOMC, whatever time it is during the day, and your press conference is at 2 o'clock or something like that?
2:30.
2:30.
Yeah.
So your decision is made by 2 o'clock or whenever it is, or something like that. So you got a half hour, but you have to avoid leaks during that half hour because that's very market-sensitive information. how do you make sure nobody is calling their spouse and saying, guess what we're going to do?
Well, people take this very seriously. None of that happens. You're taking your professional life in your hands if you do something like that. I think people have a sense of self-preservation. So people are very careful about this information. There is a period of a couple of hours after the meeting and until we announce the decision, but we announced the decision at 2. The press conference is at 2:30. So I think it's a fairly small group of senior staff and policymakers that kind of know what happened and what we're going to say. And I just think everybody understands that you've just got to be really careful with that.
To go back to the jobs discussion, if next month you had another 519,000 jobs created, net jobs, would that be good or bad from your point of view? Have we a lot of people working, but maybe producing more inflation?
So we don't have the luxury of thinking about good or bad. It just is what it is. So, but I would say again, most analysts, most economists would say that to get inflation down from high levels that we've had, if you look at history, there is some softening in labor market conditions that goes along with that, and that is still, very possible and indeed likely here. Some softening in labor market conditions. However, this cycle is different from other cycles because of where it came from, and it's just confounded all sorts of attempts to predict what it would do. So it is good that we have seen a very strong labor market, but at the same time we're seeing wages moderating. Wage increases are still very high, but wage increases have come down to a level that is closer to what would be sustainable, still well above what would be sustainable with 2% inflation. And same thing with inflation. Inflation is starting to come down and the labor market hasn't softened. We do expect that it will soften, but it will do what it will do. Our job is to get inflation down to 2% and preserve maximum employment.
So when the FOMC meets, as it does regularly, eight times a year?
Yes.
Eight times. You pretty much know how the decision is going to come out before you actually get together because you've been talking to each other? Or does the meeting of the FOMC change minds in ways that you might not have expected before the meeting started?
It depends on the meeting. I talk to each of the 18 other participants at least once, and we go through everything. What's your analysis of the economy? How are you thinking about monetary policy? How are you thinking about the path forward and all of that? So in some meetings, I will say some of the time, you get into a discussion at the meeting which suggests that maybe you should communicate differently, and then we'll think about that, and we might actually take a break in the middle of the meeting and then go off with a smaller group and think about that and come back and make changes. Sometimes, though, everything plays out as expected.
And when you're having these FOMC meetings, I assume somebody sweeps the room to make sure there's no bugs and anything?
Yes, all that.
So no leaks?
No.
Okay. And today, as you look forward, as we are going forward for the next remainder of this year, your basic view would be you'd be happy if the inflation rate were to get down by the end of the year to 2%, may be unrealistic, but your core inflation now or overall inflation you think is about 4.5%, something like that, or what would you say it is?
It's in that range. There are different measures.
Okay.
Yes, we expect significant progress on inflation this year, and again, it's our job to produce it. And I want to say again, we throw these numbers around, but the reality is we're going to react to the data. So if we continue to get, for example, strong labor market reports or higher inflation reports, it may well be the case that we have to do more and raise hikes more than is priced in.
So if I wanted to go get a mortgage on a house I was going to buy, for example, you would say I'm not going to be any better off waiting to next year than now because rates aren't going to come down that much at the beginning of next year, so I might as well get the house now, mortgage.
So surprisingly enough, I get a lot of requests for advice on those kind of things.
And you don't give any?
And but I really can't.
Okay.
I really can't respond.
So, so on the whole, to summarize where you are, you're basically saying that the jobs data that came out was a little bit surprising, but in the end, you've taken it into account and you're pretty comfortable with the guidance you gave last time, and you're not prepared to give anything that's completely different guidance than you gave last week.
Well, I mean, this is a world in which we've had the labor market report, and I think that does. I think it underscores the message that I was sending at the press conference and in the meeting that we have a significant road ahead to get inflation down to 2%. And I think there's been an expectation that it'll go away quickly and painlessly, and I don't think that's at all guaranteed. That's not the base case. The base case is for me is that it will take some time, and we'll have to do more rate increases, and then we'll have to look around and see whether we've done enough.
Okay. And 2% is the rate we had for the last 25 years before inflation came along. But prior to that, for most of U.S. history, we were higher than 2%. Is it that 2% is we're now so used to 2% after 25 years of it that you think that's the appropriate level?
So we went through this long period where inflation was really anchored around 2%. And we think that, and economists think that that's because people start to expect 2% inflation. And inflation, it's in a way, if everyone expects that prices are going to go up, prices and wages are going to go up 2% per year, then plus productivity in the case of wages, then it will. That's what will happen. Having price stability, real price stability for an extended period of time is just enormously beneficial to the public, because you can then, on the back of that, you can build a very strong labor market, as we had. We had a labor market with really 3.5% unemployment in 2018 and 19. And we had inflation running, just barely getting to 2%. Wages moving up the most for people at the lower end of the spectrum. And so this was we all want to get back to that place, but the bedrock of the whole thing is to get inflation under control.
The unemployment rate hasn't come down as much as people are going up as much as people thought. In part, some people say because we don't have as many immigrants coming into the country, legal immigrants coming in, taking some of the jobs they otherwise would take. Do you think immigration is an issue in terms of giving us more labor workers, or do you think that's not a factor?
So just as a matter of arithmetic, it was a factor because there was very little migration across borders during the pandemic. And that was part of what was happening, particularly in certain sectors like the agricultural sector and food service and things like that, where there just weren't the people. However, just very recently here, the immigration data have turned up again. And I think that may be part of why people are feeling somewhat less pressure in the labor market to find workers. This is an issue not for the Fed, though. Immigration is obviously a political issue. We do not seek to be a player on this. But it's just a fact, though, that right now the United States has fewer available workers than it has jobs plus job openings.
And when you increase interest rates, the traditional effect is to increase the value of the dollar versus other currencies. Do you have any concern about the value of the dollar going up too much, or that's not something you comment on?
So the responsibility for the exchange rate really rests with the Treasury Department and the administration, not with us. Of course, that's another financial variable that goes into every economic model, but we don't look at it as something that we're working on.
All right. Well, I think I haven't been able to get you to say anything you didn't want to say. I would say, Jay, I've known you a long time. I think you've done a great job in a difficult situation. I appreciate your service to the country at $180,000 a year, or whatever the salary is, something like that. So thanks very much for being here, and thank you for your service.
Thank you, David. Great to see you. Thank you.
Well, that was a whole lot of nothing. No real major comments that came out of that. If we checked the feed, recent immigration has turned up again. Meanwhile, more pressure for the labor markets. Actually, that would increase the supply side, so that would bring back into more balance. I'm pro-immigration, and I think that we should be more open with our borders and get rid of the old immigration system to make it easier for people to get in, because the U.S. has a terrible birth rate because it's so damn expensive to have a child. So either they need to allow more people to immigrate to our country, or they need to subsidize children more. But besides the point, inflation will not go away quickly or painlessly. This is actually something that I was a little bit shocked about. He said that it's going to be a bumpy road between now and when they're going to get inflation back to 2%. So if there's any bearish remarks out of this press conference, that's going to be it. But the rest of it, as I said in the chat, just kind of seemed like a stand-up comedy show. A lot of it was just very super relaxed, no major comments coming out of it. But we'll keep looking. Wage increases have come down to a level that's closer to sustainable, whereas it's still at like 4% wage inflation if you do it on a yearly basis. And the more people are making, the higher prices are going to go, unless we are able to fix our supply chains in order to increase the supply, because the demand is going to keep going up if people have more money in their hands to spend. So we need to get the labor market into balance, which is what he's been saying since Wednesday. So that really shouldn't come as much of a shock. But let's see. Powell says most worry about disinflation will take hold the larger services sector. Also concerned about outside events. Tools to achieve 2% inflation over time, which is interest rates. They have to keep raising interest rates higher, which we already know. But if we look at the bond market and the dollar, both of these were crushed by this event. The 10-year Treasury rate fell from 3.65 before and then fell down to 3.596. It is rebounding to about where we were earlier in the day. And then if we look at the dollar index, DXY, this fell off a cliff as soon as he started to speak, where it was 103.75, and now it's trading at 103.35. So glad that I had my gold position, GLD. Whenever the dollar goes down, gold tends to go up. I'm not seeing a major rally out of it at the moment. There is definitely a pickup in volume for GLD right now. But SPY currently trading at $411. Since there was nothing new out of this speech, I'm thinking that we're probably going to be bullish or we're going to be neutral, because we sold off on Friday and then on Monday in anticipation of this. So I don't think that we're going to go back to yesterday's levels, which was $410.79. Now, if we do, I think the comment that might send it below that would be the comment where he was talking about the bumpy road to 2% inflation. Yeah, he's more concerned about the credit market. Absolutely. He was talking about the mortgages a little bit. I'll have to replay that, and I'll do a recap on Sunday too. The recap video, I'll include a few clips that I find important. But he was talking about the mortgages and how there was a pickup in demand for home buying because of the drop in interest rates. But he is saying that they want to increase the interest rates, which is going to decrease the demand for homes because people can't afford as much home if they have to pay a higher interest in order to live there. You know, if you're paying 3% extra in interest payments, then you're paying like 50% more. Whenever interest rates for homes was like 3%, you could buy a home for like $2,000 a month for your monthly mortgage. But now with the interest rates at like 6-7%, you're paying like $3,000 for that same home. So $1,000 of that is just coming from your interest, the increase in interest rates. So that moderates demand. But my expectations probably not going to go back to yesterday's level, going to stay above $410.79. We weren't able to make it above $418.86, so I think we're just going to be in that range, probably going to be close to that 412 mark. If not there, I would expect us above that, but also below the 415 mark. So basically, I think we're going to trade within Friday's range, but we're not going to see that blow off top that we saw right before the huge sell-off. So my expectations were going to be between 412, 415. I did open some trades while he was speaking that we'll check in on. It was a put credit spread and a call credit spread. Not sure where my options are. There we go. So the call credit spread, I've already made 36. The put credit spread, I've lost $40 on, so I could have got a little bit more credit out of it. These are going for 25 cents now when I opened them for 17. I only opened 4 of them. I didn't want to put a lot of risk down. But I got 17 in credit for this. I got 10 cents in credit for the call credit spreads. So a total of 27 cents in credit for what's basically an iron condor, assuming that SPY will be between $410 and $419 by the end of today. We are pulling back to that 410 mark, interesting enough, but I don't think we're going to cross below it. But I think the sell-off before the event is just kind of unwarranted now. People were fearful of what he had to say, and since he really didn't say much at all, probably going to end up holding the levels that we were at yesterday. Let's see, the put debit spread that I opened, assuming that it would go below 406, it's basically lost all of its value. They're trading at 6 cents a piece right now. So I'm down 150 for a $200 trade almost. I think I'm going to cut my losses here just based on my analysis so far. Interesting enough, we're crossing below that 410.79 mark. Maybe I'll just hold all 3 positions open just in case. Maybe there's something that I didn't pick up, but probably just a lot of volatility before and after his speech. We were trading above 50 RSI, but now it's below. So if you're looking at technical analysis, that would be a sell-off if we're going below 50 RSI. Any updates on the app that I'm launching? I think I want to be as lenient as possible to my developer. I think that it's going to come out at the end of March. I know that it's got pushed back a few times at this point. But the design process has been taking a lot longer than what was expected because you're taking an idea and, making it a reality, which has been pretty difficult communicating that and everything. But hopefully by the end of March, we'll have that. I think I do have some design updates if I can log into my Figma. All right, I think I want to close out of this put debit spread first. Let me just focus on this trade. 16 cents, 17 cents now, 18 cents. Maybe we can wait till it hits 408.50 just to wait on some sort of support or resistance. That is a lot of volume picking up, though. That is wild. We went up all the way to 1486. Now we're pulling back to where we started this morning. Maybe the market's caught on to something that I missed. I don't know. I think it's the bumpy road comment. I think, if anything, what's causing the sell-off is the bumpy road comment. But I think that he was a little bit too kind of relaxed in that meeting to have the market sell off. All right, these are going for 17 cents a piece now. 15 cents. The bid just keeps getting lower and lower. Got 6 of them. So I'm going to try to close out of these at a loss. That's 16 cents each. That bid just keeps moving around too quickly on me. All right, 15, I guess. Save myself good $90, $96. So we got a little bit extra credit. Take my loss on it. Trades. All right. Closing options alert. Premium 101. Okay. Oh, these just jumped in price. Just cut losses on the SPY 406, 407 put debit spread that expires today. 27 at 18 cents each. And I originally picked those up at 33. Originally opened 6 at 33. So 33 minus, I guess 192 minus 96. 96 loss. Just lost 1,000 on Tesla. RIP. RIP. What's the easiest way to learn options? Just a lot of experience with it. Developing the skill of how to trade. Probably could have left that open and made a profit, but yeah, they're basically back to break even. We went below that 408.50 level, so the sell-off could continue here. There's a lot of volume coming into it. So since we saw a trough in volume on the sell-off and then an increase afterward, I think we're going to come back to $411 would be my guess. So I'm going to keep on holding the put credit spread, assuming that will be above 410. Right now, these are going for 65 cents a piece, so a lot of... I think I want to open some more, honestly. Just a couple more to make up for the low cost that I got them at, or low credit that I got them at. 17 times 4. Total credit, 17 times 4. Total credit of 68. I'll probably only open like 1 or 2 of them. But man, we are really plummeting right now. Lots of volume picking up. All right. 62, 63, 68. Jesus. All right. I'll just put in the order for 63 and call it a deal. Just one of them. The bid ask on it is just fluctuating so much. Come on now. Yeah, we ended up bouncing at 407.50. So that order did not get filled. Fun. 0.61. There's just so much volatility. It makes these that much harder to open. Can't even open them at 60 now. Come on now. Damn. These orders just aren't getting filled for the life of me, man. Dollar index is back to break even. Treasury rates actually increasing. Still not getting filled for that credit spread, though. Man, this is horrible. Because I know the bid is way Like, the bid is 66 and this order isn't getting filled. That's ridiculous. Oh, I was trying to close it. That makes sense. Ugh, how annoying. 62. Alright. Looks like we're headed back to 408.50. I'll have to open this at 60. Give the buyers what they want. There we go. So we raised our average credit up to 31 cents now. Now we got 5 of them. So a little bit of extra credit on the table that we can make. Options, alerts, day trade, premium 101, freemium. Just opened another SPY 410, 411, but credit spread expiring today. 27 at 60. So now got a total of 6 of these at 31 cents piece, so 150 that I can make on it. 5 open now at 32 average credit. All right, so we are getting a bounce right now. Again, like I said, the volume was troughing right here whenever we were selling off, and now it's starting to pick up. So I think we're gonna come back to retest that $410 or 410.79 resistance. Do you need Robinhood Gold for advanced charts? I'm not sure about that. Not too sure. Still got an hour, 2.5 hours until the market closes, so gonna be a pretty wild end to the day. No, you don't pay any commissions for trades on Robinhood, but the bid-ask spreads are very, very wide in comparison to brokers that you do pay a fee or commission on. So you can probably save money if you use another app. But yeah, you can use limit orders to kind of negate that problem. But at the same time, like, you're just not going to get good prices on Robinhood. All right, drop in volume here. So we could end up holding 408.50. So put credit spread assuming over 408 might not be a horrible idea. Yeah, thinkorswim charts are definitely the best. Most customizable, which is what I like about them. Oh, shit. I put in the wrong strike prices. Whoopsies. That's okay. All right. So, yeah, I think we're probably going to hold 407, 408. So, probably could have went lower with my strike prices and not taken on as much risk, because now SPY has to go back above $410. Right now it's trading at 409, so it's not super unlikely, but at the same time, it would have been better to choose a lower strike price. That way, you know, I wouldn't have to worry as much towards the end of the day, especially with Robinhood and pretty much any broker you use. If the stock is trading close to your strike price, the broker is going to close out of the trade for you because of what's known as pin risk. So they'll usually close it at 3:30. Other brokerages will allow you to carry it until 3:45. I know that Aries will let you if you call up TradeStation and ask their customer service to extend it. And I know that Tasty Trades, they have some sort of thing to where they send you a notification of your options about to expire, and you can say, I'm monitoring or something like that, and then they'll allow you to carry that option, those spread options, for another like 15 minutes or so. This is Thinkorswim that I'm looking at right now. Yeah, the volume is definitely slowing down, though. So, holding that 408.50 level would be more likely if volume is continuing to slump. And the volume is these blue bars at the bottom. UUP for a good log call. If you expect rates to keep going up, yes, because the dollar will be in shorter supply as interest rates go up. With the Fed saying that they're going to be data dependent, that does increase the possibility of them pausing interest rate hikes or cutting rates. But at the same time, like, we need to tame inflation, and the only way to tame inflation is getting the labor market back into a regular supply and demand. So in order to do that, you have to raise interest rates. And something that I actually wanted to show y'all over on Twitter is something that Maverick of Wall Street and Liz A. Sanders ended up posting. So we'll head on over there. This chart is very telling right here. Nope. Where is it at? There we go. So this is the unemployment rate, and these gray vertical lines, or columns, I guess, these are recessions. So basically, any time that you see the unemployment rate going low is usually followed up by a recession. Pretty much every single time, that's when the unemployment rate ended up bottoming, right? And then you see a increase in the unemployment rate as a recession takes place. And then now, if we're going to go lower than we were pre-COVID in terms of the unemployment rate, like much lower, then we could still see expansion for the economy. But considering that we're in a fiscal tightening period and interest rates are going up so quickly, that makes it a lot less likely for the economy to continue the growth that it's seen. Now, it's not to say that it can't continue growing, because we do have so much money that was placed into the market, 40% of the U.S. dollar that was printed over the last 2 years since COVID, 3 years almost since COVID. So given that there was so much money supply added to the economy, it might take a while for that money to be kind of wiped out. So we might see unemployment rate continue to tick lower, but eventually, we are going to get the recession. And usually what ends up sparking these recessions is the fiscal policy, the increasing interest rates, and the decline of money supply in the market. And if you look at like the Fed balance sheet, this has decreased by about $500 billion or so since the peak in March when they started to increase interest rates. But, it's still at a level of $8.4 trillion compared to pre-COVID. They had a balance sheet of $3.7 trillion. So they added almost $6 trillion to their balance sheet since COVID. So there's so much more money flowing through the economy because of their balance sheet increases, and now they're trying to suck the liquidity out of the market, but it could take a while just because of how much money they put into the economy. does anxiety or stress ever affect what I do for a living? I would say that I'm not a very anxious person. I don't get very stressed often. Like, if I'm making a trade, I know that there's a good chance that I'm wrong and that I'm going to lose money. And I don't really stress about that. I do what I can in order to manage my positions, to hedge my positions. And that really reduces my stress personally. If I am bullish and bearish at the same time, then in the end, probably I'm going to at least break even. So as long as my account isn't getting drained like hell and I'm losing trade after trade, I would say, yeah, my stress levels are pretty low. But, there are weeks or even months sometimes where my account does see a decent drawdown. And that, I would say, is pretty stressful for me just because, this is what I do for a living. And I feel like if I'm not performing to my expectations, then like I'm failing myself at my job, basically. So it does have a little bit of a role, but it's kind of seasonal, I would say. Do I hold any dividend stocks or bonds? No, I do not have any dividend stocks or bonds. The only value play that I have is in GLD. So the reason why I chose GLD is with the falling dollar. If the dollar does fall, then the price of gold will go up. These trade inverse with one another. But you will also see an increase for staples like McDonald's, Coca-Cola, Walmart. Those three would do well. So you want to look, at least for right now, you want to look for value stocks during a time of recession, and these will generally outperform tech names, especially with the rising interest rates. Another place that is decent to put your money in would be healthcare. So healthcare would include things like Thermo Fisher, TMO. And, these stocks have already seen a decent bit of a rally with Thermo Fisher bottoming out at 475, and now it's trading at 580. I remember owning the stock about a year ago, and I think that I sold it close to the levels that it's at right now, around $580. But, during a time of recession, people still need to go to the doctor. It's not like people are just going to stop going to the doctor because they're unemployed. Well, I guess they would stop going to the doctor if they're unemployed and they don't have benefits. But Thermo Fisher and, these healthcare names are less affected by the recession than names that have been doing so well over the last few years, especially tech. Get very nervous on the contract expiring between my strike prices. Any advice? It's with as volatile as the market is, chances are the stock is going to come close to the strike prices that you choose. So I'd say it's very hard to really avoid that. What you could do potentially is extend the expiration date. So maybe instead of doing 0 data expiration options, you could try like 1 or 2 days. And you will take on more risk, right, because of the market volatility, but chances are the stock won't be as close to the strike price that you choose. And you can always close out of the spread before 2:30 or whenever your broker decides, 3:30 or whenever your broker decides to close it for you. So you could mitigate that stress by closing it. I usually close these kind of trades at like 2 p.m. to 3 p.m., somewhere in that range. So if I know that I have an option expiring for the day and the stock is close to the strike price that it chose, then I'll try to close it between 2 and 3 p.m. That's the way that I deal with it. SPY's making a little bit of a comeback back above 408.50. But let's see. Got a double bottom. We traded it down to 30 RSI, so we almost got oversold. Powell said that he expects inflation to decline in 2023. He said it will take some time to get inflation down. The Fed will need further rate hikes. That's to be expected. That's what the markets already know, considering if you look at the summary of economic projections, we know that we're not going to get back to 2% inflation. I think until 2024 is what they projected. So that's not really news. But the big thing that he said was that the road to getting inflation back to 2% is going to be bumpy. So we might see inflation picking back up in some points during this fiscal tightening. So if it does, that might mean that the Fed would have to increase rates at a higher rate than they did previously. So if we see something like the inflation report that's coming out next week coming in super hot and unexpected, then the Fed might have to be doing a 50 basis point rate hike when last month they did a 25 basis point rate hike. So if they have to maneuver like that, that would end up in the markets being pretty tough and selling off. And you can always track the interest rates and what they're going to be. The Fed has followed this almost to the T. FOMC countdown tool from the CME group. And I'm sure this hasn't changed by much. There's a 94% chance that we're going to get a 25 basis point rate hike in March, on March 22nd. And this is actually down a little bit from 97% a day ago. So the Fed speech actually cooled off that a little bit. But if we go out to September, it's expected to be at 5%. That's nothing new. Let's see what the December is. So they're still expecting the 25 basis point rate cut in December. So really nothing has changed here from yesterday. They're expecting another 25 basis point rate hikes, and then the Fed is going to pause until December, and then they'll start to cut rates. But this is also variable. It's also, based on the incoming data. So if the labor market comes in hot again, then they might get rid of the 25 basis point rate cut in December, and then move to just staying flat at 5%. Yeah, I usually close on the day that my spreads are expiring, and I try to close it about an hour ahead of time. All right, we're above that 408.50 level. So the put credit spreads that I opened ought to be recovering a little bit at least. I'm sure that I'm still getting murdered by this trade. Down $150 at the moment. I would say probably coming back to the average price, which would be somewhere between 25 and 45. So 20-cent difference. They'll probably come down to about 35 cents each if I had to guess. But that's if the markets do end up recovering. If they do continue to sell off, obviously these would be at max loss if SPY is below 409. Thoughts for eBay? Never traded this stock. I feel like eBay is so old and antiquated at this point. 99-cent earnings, 105 earnings. So they're, one of those legacy companies that is profitable. The 5-year horizon, they're basically break even over the last 5 years, a little bit up. Let's see, did they pay a dividend? Yeah, they do pay a dividend of 22 cents for a $49 stock. So around 0.4% dividend. Not a lot, but a little bit of something, I guess. I don't know. eBay, I just feel like it's so old and antiquated. I don't feel like anybody uses eBay anymore. Maybe I'm wrong. But I can't even remember the last time that I used eBay myself. What's my biggest win on a trade? I won really big on a trade that I made back in September. It was a put debit spread assuming that SPY would fall by 4% for Jackson Hole, if y'all remember that event. And the markets weren't expecting a 4% sell-off that day, so the options that I bought them dirt cheap for like 5 or 10 cents each. And then I ended up selling them. I got forced into selling them, actually, because of the 3:30 cutoff. I got forced into selling them at, I think, 25 cents each. So I bought, 20. I sold at 25. I bought at 5. So I had a 5x profit on that. And I think I spent, I only spent like a few $100s because that was a gamble, to say the least, expecting SPY to fall that much. I think it was like $300. So I made like $1,500 on that one trade. But I basically spotted a discrepancy between where the markets were trading and where they might go after the speech that he gave at Jackson Hole, which was probably the most hawkish that Powell had ever been during this fiscal tightening. So since I was able to spot that discrepancy and got a little bit of luck on my side, I was able to make 5 times profit and around $1,500. All right, we're just kind of chilling out right now. It seems like just above that 408.50 level. Not really too high above it. I wonder how much we can get for like a 407 or 406 call credit spread. Will the app be able to track the break even for a poor man's cover call? Yeah, it should be able to track that for you. I can ask my developer for it to add that feature. And it's not just going to be set in stone. Like, the features that we have are like end all be all. It's a work in progress. The plan right now is to launch it by the end of March. We're going to do something along the lines of the people that sign up within the first month of it will get like a 30-minute Zoom session with me. That way I can kind of survey what people want and give a little bit of feedback too on people's trading. So it'll be kind of a symbiotic relationship. I help you out, you help me, to develop the app to make it a little bit better. We just want to make it the best options journal on the market, and I feel like the best way to do that is by actually surveying the people. So the first people to sign up for it, it's either going to be like the first 100 people to sign up for it, or it's going to be the first people to sign up within the first month of it launching. They're the ones that are going to get the 30-minute session with me. Poor man's cover call. Call it a diagonal spread. You could call it a diagonal spread. I don't know if it would be a calendar spread. I don't think a calendar spread is the same thing. I think calendar spread's a little bit different. But yeah, I mean, that's the colloquial name, is the poor man's cover call. We all pour out here. Yeah. we're definitely headed up now. We caught that support at 408. And now it's coming back up to 411. So that's the hopes, at least, that we go back to 411. With the decline in volume, I would think that that would be the likely case, but there's really no telling with this market as crazy as it is. How long did it take me to learn how to do a call debit spread? It didn't take me too long, I guess. So, I mean, I've been trading options for 3 years, and I would say I started to use spread options in my second year of trading. So I started in March of 2020, and I think I started to use spread options in probably like June of 2021, and then towards the end of 2021. And then basically throughout 2022, that's almost all that I used. Like if you go back and look at my stats, I would say that more than 50% of my options are probably even along the lines of like more than 80% of my options are spreads. All right, we're back above 410. Slightly. So, kind of an overreaction to the upside, and then an overreaction to the downside, and now we're kind of finding a balance in between. I would say, though, that spread options, debit spreads, and credit spreads, they're the most capital efficient. Like if you're doing regular calls or regular puts, you have to deal with the headache of implied volatility in Vega. You have to deal with a lot more theta decay. There is still theta in Vega for spread options, but it gets a lot reduced because you're buying an option and selling a separate option. So those theta and Vega values balance out to some degree. So that's why I prefer spreads myself. You can trade regular calls, regular puts, but I really just haven't found that much success with them, personally. It's not to say that you can't have success with regular calls and regular puts. Like, there's plenty of people that can. But my main strategy and what I've really kind of honed in on has been spreads. Microsoft is going to start integrating artificial intelligence into Bing. Bing is still around. I didn't even know Bing was still a thing. It would be interesting if Google did the same thing. Google is the one that should have bought ChatGPT instead of Microsoft. If they did, they would be a powerhouse. Saw a drop coming for SPY, taking off like an absolute banshee. Knew the drop was temporary, but man, yeah. They really didn't. But nothing really came out of it, though. Like, he was very relaxed during the meeting. There was a lot of laughing going on to the audience. So, I mean, considering the tone that he had, considering that there was nothing new about it, like, that was bullish, or dovish. And then the hawkish remarks that he gave, the negative remarks that he gave, was that inflation is going to be a bumpy road, and we're just going to have to keep increasing interest rates, which we already know. What we didn't know was the bumpy road part, to where we might see inflation pop its head back up and come in higher. And if we do get that higher CPI, that would be really bad for the market, because the markets expect that inflation has peaked. So if we see any marginal increase for the CPI, markets are going to panic at that. What is BARD? I've never heard of BARD. Let's see. Google BARD. Google AI updates BARD and new artificial intelligence features. From Sundar Pichai, CEO. Okay. Introducing BARD. It's a really exciting time to be working on these technologies. Deep research and breakthroughs into products that truly help people. Lambda, language model for dialogue applications. I really wish that they would do more in terms of translation and increasing the number of languages that are available for Google Translate would be really beneficial. All right, we just hit that 410.79 mark, so let's see. Volume is increasing and the last couple of volume bars. So if we continue to see the volume increasing here, then we're probably going to come back to test the 410.79 mark. Chat GPT. Oh, really? In Google search. That's a powerhouse right there. Thoughts on Waller? Waller is the second. No, actually, I think Waller is the most hawkish member of the Fed. Let me pull out the Fed cheat sheet. But Waller is the most hawkish member on the Federal Reserve Board, or second most hawkish. So we already know that what he's going to say is going to be more in favor of raising interest rates. Like Bullard was saying, the most hawkish member was saying that he would rather front load the interest rate hikes than wait and see. So Waller is probably going to say something along the same lines. Let's see. Let me pull up what he's speaking about. It's also important to know like what these Fed speakers are speaking about. What's the topic, right? So if you go to the Fed speaker calendar, this right here, this will give you the subject that they're talking about. So it might be an unrelated subject to where there's nothing that'll come out of it too. That's a possibility. But for tomorrow, Fed Waller is expected to speak. Oh, actually, Fed Barr is speaking right now. Financial inclusion is the topic at the moment. And then Barr is speaking at 10 a.m. tomorrow. And it's a conversation with students at the Hope Economic Mobility Career Expo. So I don't think much of it is going to be he's not going to be talking about fiscal policy so much with students. I'm not really sure what they would be talking about, but let's see. Barr is speaking right now, and I think Barr is in the middle. Yeah, Barr is a slightly dovish member, the third most dovish member of the Fed. Let's see if we can pull that up. Yeah, nothing really coming out of that. Just a speech on financial inclusion, which, yeah, that's important, but it's probably not going to move the markets in one direction or the other. He's probably not going to make any comments on the fiscal policy, so it's not going to shift the markets in one direction or the other. But SPY is making its way back up, currently trading at $411.69, so we're making our money back from the SPY put credit spreads up $100 at the moment. These are trading at 15 cents a piece now. Try to get out when it's closer to 412.36 and then just call it a day there, hopefully. All right, I'll probably have to get the order at 15 cents if I had to guess. Robinhood is glitching out on me today like hell. Like, it's not even showing the put credit spread now. I swear, it's just trying to take my money, man. What the hell? Why is it not showing the position? Alright, well, I guess I'll have to do it on my phone. That's annoying, but... Alright, so I got 6 of these. I'm going to try to close them at 15 or 16 cents a piece. And I would like to close them when we're closer to 412.36, but considering the increasing volume, we might end up coming back to test 410.79, so I'd rather be a little bit more lenient, I guess, and try to take my profits while I'm ahead than wait till it hits 410.79. All right. So they're going for 20 at the ask price. I want to get them for less than 20, but can't be overly greedy at the same time. It's hard to find a balance between greed and losing money. All right, I'm trying to close them at 18. I originally opened them at like 31 cents each. So that would be, let me see. All right. Yep, they got filled at 18 just now. Okay. Closing options alert. P1F just took profits on the 410, 409 SPY put credit spread that expires today. 27 at 0.18 each. And my credit on average was 32 cents. 32 average credits. Opened 5 of them at 32. Oh geez, I can't type. 5 at 32 average credit. All right, so that would be 32 times 5, and I paid 108 to close. Minus 108. $67 in profit that I made there. 67 profit. Still gonna have to make up for the money that I lost with the put debit spreads that I had opened. I wish I had waited a little bit longer when we were trading below 408.50. I could have cut my losses to a lot smaller, but you know, timing the market is never going to be perfect. The 419, 420 call credit spread, basically max profit at this point. I could close them at 4 cents each, or sorry, 1 cent each, and I'll do that just in case the markets decide to be absolutely insane and make their way back up. If I can close them at 1 cent each, hopefully. Yeah, it's not even filling at that price, so might just have to leave it alone. I mean, the odds of going back up to 420 at this point, pretty low. Not zero, but I would say pretty low. What are my thoughts for PayPal earnings? I think I opened a PayPal trade, if I remember right, yesterday. PayPal, I opened a put debit spread. My assumption is that they're going to go below $83. Currently, they're trading at PYPL. Currently, they're trading at $82.20. So this has basically become a call credit spread, assuming that it will be below 83. But Wall Street expects their margins to improve by about 10% based on an increase in revenue of around 20% year over year and a 30% increase in earnings per share. But I don't see how they're going to make up for that extra margin considering that they haven't raised the fees that they're charging and considering that the US dollar is a lot higher than it was a year ago. So, in my opinion, their margins are going to decrease, which means that their earnings per share is likely to come in lower than what's expected. So, I ended up taking a put debit spread, and I'm only assuming that it'll be below $83. So, but yeah, that's all the trades that I got today for y'all. Still holding some put debit spreads for NVIDIA. Still holding that gold call. If we check out the dollar, it's basically flat. DXY. Trading just below yesterday's close, actually. So it is down today. And then the 10-year Treasury yield is actually a little bit higher. So kind of balancing out. Probably going to not see much price action for the rest of the day. So I would think that we're going to end the day. I don't know. I first expected us to be between 412.36 and 414.86. And I think that's going to be the end of day range in that price level, between those two price levels. So I would say that we're probably going to end the day at like 413.40 or something like that. You could take an iron butterfly, assuming that, but I'm already over trading today. I already made like 3 trades. So let me log the trades that I made today and then call it a day and go to the drive. Very nice, $200. I think I lost money today because of the put debit spread that I had opened. I think I lost like 150 on it. And then I only made 60 for this, and then I made 40 from the call credit spread. So I think I'm going to be at like a $50 loss or something like that for today. But the put credit spread, assuming... did I close this already? Let me scroll through my Trade Alerts tab and go to the beginning of the day. Alright, so opened the gold leaps yesterday. Today I had the 407, 406 put debit spread that I opened at 32. I ended up closing these same spreads. Put debit spread, I think at like below 15. No, actually 18 cents each. All right, so that one I lost $84 for. Closed them today. Closed, not expired. All right, and then we got another new options alert, 409, 410 put credit spread that I just closed out of. So this is a day trade, 410 SPY put credit. This is a bullish / neutral trade. Expiration was today, so another day trade. Strike prices I chose was 409 and 410. I opened 5 of these at 30, 32 average credit. I ended up closing them at 18. Oh, I put this in the wrong spot. Wait a minute, this doesn't seem right. Did I really open and close these both at the same prices? That would be a huge coincidence. Yeah, I think I did. That is really weird. There's got to be a mistake. Let's see. No. Just an enormous coincidence. What is the most I've ever lost on a debit spread? I used to trade really heavy. I would trade like $1,000 or $1,500 at a time. So that would be my max loss. Would be like, I would say $1,500 for a debit spread. In the very beginning, when I first started trading and I didn't know anything about risk management, I put up $12,000 on a Tesla trade that ended up going south. So that would be my biggest loss. But as of recently, since I've learned risk management, it's been about $1,500. But now I'm only taking on risks of between like $300 and like $400 is my max risk these days. And ever since I decreased my risk, it's been more profitable ever since. I've been able to manage the trades a little bit better, but I'm hoping to increase my risk tolerance a little bit, slowly but surely. On that Tesla 12, yeah. No, I didn't have a stop loss. I still don't believe in stop losses at this point. I monitor the trade at all times, so it doesn't really make sense for me to have a stop loss. I would rather have control of when I get closed out of the trade rather than have the market executed at whatever price it goes to. I always do limit orders and never stop losses. But let's see what else we got. All right, so 420, 419 call credit spread that we opened. All right, 410, 49. We already put that one in. 406, 407 put debit spread. Okay. I already put that. All right, so I think that's all the trades that I made today. So let me just input this last one, the 419, 410 call credit spread. This one is going to expire SPY call credit spread. Usually it auto inputs it, but not doing that today. Bearish to neutral. Expiration date was today. And I chose 420 for the long, 419 for the short. Let's see. I think 4 of them, that is what I opened. 4 at 10 credit. So I didn't get a lot of credit out of it. But this one's probably going to expire at worthless, so I won't have to pay anything. Don't want to count my chickens before they hatch. So I won't type in the order yet, but it is going to expire today, close today. And all of these trades were based on POWELL, so these will get labeled as red for econ data or economic news. I don't really have much emotion when it comes to trading. Like if I take a loss, then I take a loss. I don't try to bag hold a trade too often. Try to be as, level-headed about a trade as I can be. And that also comes with only risking, 2 to 5% of your account on each trade. Like if I lose 5% of my account on a trade, I can do that 20 times in a row and I'll be fine. Or, 20 times in a row, and then I would lose all my account. But what are the odds of losing max loss 20 times in a row? That's what I would try to do. Reduce your risk as much as possible. Keep your position sizes between like 2 and 5%, and just manage your trades the best that you can. That's the way that I've done it for the last couple of weeks. Let's see. Today I did end up losing $14 so far. I will make up for that with $40 in profit probably. So I'll probably end the day with $26 in profit. Not a lot, but at least it's positive. That would be 1, 2, 3, 4, 5 days in a row that are positive. The goal at least is to make $100 a day, but sometimes you just can't hit your goals. Like I did on Thursday, I only made 77. Today I'll only make like 40. But as long as I stay positive, I'm happy. And if I can make $100 a day, that's ideal. Yeah, I have a trade on Bank of America. It's a Leaps put option that expires in, I think, the end of 2024. So I have a long time for this trade to work in my favor. Right now it's trading at the strike price that I chose. It was trading at a 52-week low, and I think that banks are going to have a hard time lending money out with the higher interest rates. So that means that their revenue and their earnings are going to come down this year. So I'm just going to keep on holding this and waiting for that situation to play out. And eventually Bank of America will go to a new 52-week low, I think. But let's see. Yeah, I paid $2,100 for this. I could do cover calls. That might actually not be a bad idea. Wait, it's up by... Okay. I just don't want to end up losing my leaps option. Or I guess not poor man's cover calls, but poor man's cash secure puts, I guess. Let's see. Bank of America. But if I sell a cash secure put, that means that I assume that it's going to go up. So it's kind of counterintuitive to what I want out of it. But yeah, it's up 1% today. So just going to wait for it. Since it's the leaps option, I have until, let's see. I have until January of 2025, actually, for this to come down. And my break even for this trade is 29.80. So it has to fall 29.8 over 37. It has to fall about 20% from where it's trading right now. We'll see. I think the next few bank earnings are probably going to come in worse and worse, which will end up in Bank of America and the rest of the banks coming down. But yeah, that's all the trades that I got for y'all today, and I will catch y'all at 9:30. See you, everybody.